Before you place your next trade, you need to hear this. Every trader wants control, but control is what destroys them. You felt that panic when the chart moves against you and your brain whispers, "Do something, anything." That voice has cost you more money than any strategy ever could. Today you'll finally understand why your brain trades against you, and more importantly, how to trade with it instead. Picture this. A young trader named Alex sits in front of his screen at 2 a.m., tired eyes fixed on a position that's deep in the red. He's already down $300 on what was supposed to be a quick scalp. His finger hovers over the mouse, torn between cutting the loss and holding on for a miracle. The rational part of his mind knows exactly what he should do, but there's another voice, louder and more insistent, telling him that winners never quit. That this is just a temporary pullback, that he can't afford to take another loss today. Sound familiar? That internal war isn't a character flaw, it's not weakness. It's the collision between two different operating systems in your brain, one designed to keep you alive, the other designed to help you think, and in the heat of a losing trade, survival wins every time. Warren Buffett understood this battle better than most. He once said that temperament, not intelligence, is the key to successful investing. But here's what most traders miss. Buffett didn't develop that temperament by reading books or attending seminars. He forged it in the fire of his own costly mistakes. Mistakes that cost him not just money, but something far more valuable: his confidence in his own judgment. The lesson that changed everything for Buffett isn't found in his annual letters or his famous quotes. It's buried in a confession he made decades later about the worst stock decision he ever made, Berkshire Hathaway itself. A failing textile company that he purchased not because of sound analysis, but because his emotions got the better of him. That single decision, driven by anger and ego, cost him an estimated $200 billion in opportunity cost. $200 billion. Let that sink in for a moment. The greatest investor of all time made an emotional decision that cost him more money than most countries' entire GDP. If Warren Buffett, with all his wisdom and experience, could fall victim to his own psychology, what chance do the rest of us have? But here's where the story gets interesting. That mistake didn't destroy Buffett. It transformed him. It taught him something that no amount of financial education could have provided: the understanding that markets don't just test your knowledge of valuation or your ability to read charts. They test your ability to remain rational when every instinct in your body is screaming at you to act irrationally. Most traders learn this lesson the hard way. They blow up accounts. They chase losses. They revenge trade their way into major financial setbacks. And then they either quit, convinced that trading is impossible, or they start the cycle all over again with a new account and the same broken psychology. You see, the human brain wasn't designed for trading. It was designed to help our ancestors survive in a world where quick decisions meant the difference between life and death. When a saber-toothed tiger appeared, you didn't have time to analyze the situation. You ran. Fast decision-making was literally a matter of survival. But financial markets don't work that way. In trading, the quick decision is often the wrong decision. The obvious move is usually the trap, and the action that feels most urgent is frequently the one that will cost you the most money. Your brain doesn't understand this. When you see a position moving against you, ancient survival circuits activate your amygdala, the fear center of your brain, floods your system with stress hormones. Your heart rate spikes, your vision narrows, your prefrontal cortex, the rational thinking part of your brain, goes offline, and suddenly, you're not a sophisticated trader analyzing probabilities. You're a frightened animal looking for an escape. This is why discipline feels so hard. You're not just fighting the market. You're fighting millions of years of evolution. Every fiber of your being is telling you to do something, anything, to make the pain stop. But the market rewards the opposite behavior. It rewards patience when you feel panicked. It rewards stillness when every instinct screams for action. Buffett learned to recognize this internal battle early in his career, but the lesson came at a steep price. In 1988, he made what he later called a terrible timing decision, investing heavily in Coca-Cola right before the market crashed. The position eventually became one of his greatest successes, but not before testing his resolve in ways he hadn't anticipated. The crash of 1987 had left many investors deeply shaken. Markets were volatile. Fear was in the air, and when Buffett announced his massive position in Coca-Cola, critics questioned his judgment. The stock price fluctuated wildly. For months, it looked like he had made another costly mistake, but this time was different. Instead of letting emotion drive his decisions, Buffett had learned to separate his feelings from his actions. He had developed what he called a temperamental advantage, the ability to remain calm and rational while others panicked, to think in decades while others thought in minutes. This wasn't a natural gift. It was a skill forged through painful experience. Each mistake had taught him something about his own psychology. Each loss had revealed another way his emotions could sabotage his judgment. And slowly, methodically, he had built a mental framework that could withstand the psychological pressure of volatile markets. The framework wasn't complicated, but it was revolutionary in its simplicity. Before making any investment decision, Buffett learned to ask himself 3 questions. First, do I understand this business well enough to predict its future with reasonable confidence? Second, am I buying it at a price that offers a significant margin of safety? And third, am I making this decision based on logic and analysis, or am I being driven by fear, greed, or other emotions? That third question was the game changer. It forced him to pause, to examine his own motivations, to distinguish between rational analysis and emotional reaction, and over time that pause became second nature, a mental circuit breaker that prevented costly impulsive decisions. But here's what most traders don't understand about Buffett's approach. It's not about eliminating emotions. That's impossible. Emotions are hardwired into our brains. They're part of being human. The key is learning to acknowledge them without being controlled by them, to feel the fear without letting it dictate your actions, to experience the greed without letting it cloud your judgment. Think about the last time you made a trading decision you later regretted. What was happening in your mind at that moment? Were you calm and analytical, or were you feeling something intense? Anger at a previous loss, excitement about a potential win, fear of missing out on a big move? If you're honest with yourself, you'll probably recognize that your worst trading decisions weren't made when you were thinking clearly. They were made when you were feeling strongly, when emotion had taken the driver's seat and logic was relegated to a passenger. This is the Warren Buffett lesson that traders learn only after losing money. Success in markets isn't about being smarter than everyone else. It's not about having better information or more sophisticated strategies. It's about developing the emotional discipline to make rational decisions under pressure, to remain calm when others panic, to be patient when others rush, to think independently when others follow the crowd. But discipline isn't something you can simply decide to have. It's a skill that must be developed through practice, through making mistakes and learning from them, through experiencing the sting of poor decisions and using that discomfort as motivation to develop better habits. Every successful trader has a story like Buffett's Berkshire Hathaway mistake, a moment when emotion got the better of them and cost them dearly. The difference between those who ultimately succeed and those who don't isn't that the successful ones never make emotional mistakes. It's that they learn from those mistakes and use them to build stronger mental frameworks. The market is unforgiving. It will exploit every weakness in your psychology. Every bias, every fear, every overconfident assumption will eventually be tested. And if you haven't learned to manage your emotions, those tests will become expensive lessons. But here's the paradox that Buffett discovered. The very experiences that seem to prove you can't succeed, the losses, the mistakes, the moments of panic, are actually the raw materials for building the psychological foundation that success requires. Each painful lesson is an opportunity to understand yourself better, to identify the emotional triggers that lead to poor decisions, to develop the mental habits that separate rational analysis from emotional reaction. The question isn't whether you'll face these challenges. You will. Every trader does. The question is whether you'll use them as stepping stones toward greater discipline and understanding, or whether you'll let them convince you that success is impossible. The market doesn't care about your past difficulties. It doesn't care about your mortgage payment or your dreams of financial freedom, but it knows exactly how to trigger old emotional patterns you carry, and it will exploit them with remarkable precision until you either learn to adapt or step away discouraged. This is what Buffett discovered in his early years, though he would never frame it quite this way. Every losing position became a mirror, reflecting back not just poor analysis, but unresolved emotional patterns, the anger that made him hold losing trades too long, the pride that prevented him from admitting mistakes quickly, the fear that paralyzed him when decisive action was needed. Most traders never make this connection. They see their losses as random bad luck or market manipulation. They blame external forces because looking inward is too painful, but the market is simply responding to who you are at your core. Your unconscious beliefs about money, success, and self-worth are broadcasting through every decision you make. Consider this psychological experiment: two traders with identical strategies and identical capital start trading the same day. One grew up in a household where money was scarce, where financial mistakes were met with shame and anger. The other grew up in an environment where money flowed freely, where losses were seen as learning experiences rather than personal failures. Who do you think will be more likely to cut losses quickly? Who will be more prone to revenge trading after a string of losses? Who will have the emotional stability to stick with a proven strategy during inevitable drawdowns? The trader with the scarcity mindset will unconsciously sabotage their own success. They'll hold losing trades because closing them feels like admitting they're not worthy of financial success. They'll overtrade because they're desperate to prove they deserve money. They'll abandon profitable strategies after short-term losses because their inner critic tells them they always mess things up. Meanwhile, the trader with the abundance mindset will treat each trade as just another business decision. Losses won't trigger overwhelming emotional reactions. Wins won't create dangerous overconfidence. They'll stick with their edge because they trust the process more than they fear the outcome. This isn't about privilege or advantage, it's about recognizing that trading psychology goes deeper than simple discipline. It reaches into the fundamental beliefs you hold about yourself and your relationship with money. And until you address those beliefs, no strategy in the world will save you from self-sabotaging decisions. Buffett learned this lesson through a series of painful mistakes in his early career, but perhaps none was more instructive than his investment in ConocoPhillips in 2008. Here was a man with decades of experience, legendary analytical skills, and virtually unlimited resources. Yet he bought into an oil company near the peak of oil prices, driven not by careful analysis, but by the psychological trap of momentum investing. The loss wasn't just financial. It was a stark reminder that even the most sophisticated investors are vulnerable to cognitive biases and emotional decision-making. Oil prices had been rising for years. The narrative around peak oil and growing global demand seemed compelling, and like countless traders before him, Buffett extrapolated recent trends into the future. But markets don't move in straight lines. They move in cycles of fear and greed, expansion and contraction, hope and despair. And those who prosper are not the ones who predict these cycles perfectly, they're the ones who maintain psychological equilibrium throughout them. This is why Buffett's greatest skill isn't stock analysis or business valuation. It's his ability to remain emotionally stable, while others around him lose their composure, to buy when others are selling in panic, to sell when others are buying in euphoria. To sit patiently when others are frantically searching for action. But stability isn't the absence of emotion. It's the ability to feel emotions fully without being controlled by them. When Buffett watches a stock he owns drop 20% in a day, he feels the same gut punch that any investor would feel. The difference is that he's trained himself to pause between feeling and action, to create space for rational thought even in moments of high emotional intensity. Most traders skip this crucial step. They feel fear and immediately act to reduce that fear. They feel greed and immediately act to satisfy that greed. They feel anger and immediately seek reactive decisions against the market. There's no pause, no space, no opportunity for wisdom to intervene between trigger and response. This reactive pattern is what destroys trading accounts, not lack of knowledge, not bad strategies, not market manipulation, simply the inability to create space between stimulus and response, the inability to feel without immediately acting on those feelings. Think about your worst trading day, the day you lost far more than you planned to risk. What was happening inside your mind during those crucial moments? Were you calm and analytical? Or were you caught in an emotional storm, making decision after decision from a place of fear, anger, or desperation? If you're honest with yourself, you'll recognize that your worst losses came not from market unpredictability, but from your own emotional reactivity, from decisions made in the heat of the moment rather than from a place of centered awareness. This is the deep lesson that Buffett learned through decades of expensive mistakes, that successful investing isn't about being right more often than you're wrong. It's about making decisions from a state of emotional equilibrium rather than emotional reactivity. It's about developing the psychological infrastructure to remain grounded when everyone around you is losing perspective. But how do you develop this infrastructure? How do you train yourself to remain calm in the storm of market volatility? The answer lies not in suppressing emotions, but in changing your relationship with them. Instead of seeing fear as something to be eliminated, you learn to see it as information. Instead of viewing greed as a character flaw, you recognize it as a natural human response to opportunity. Instead of judging yourself for feeling angry after a loss, you acknowledge anger as a normal reaction to unmet expectations. This shift from resistance to acceptance is profound. When you stop fighting your emotions, they stop controlling you. When you acknowledge fear without being paralyzed by it, you can make decisions that account for risk without being dominated by it. When you feel greed without being consumed by it, you can recognize opportunity without abandoning prudent position sizing. Buffett calls this developing a temperamental advantage, the ability to remain rational when others become irrational, to think clearly when others are clouded by emotion, to act decisively when others are paralyzed by fear or blinded by greed. But temperament isn't fixed. It's not something you either have or don't have. It's something you develop through practice, through making mistakes, through learning to observe your own mind in action. Every losing trade is an opportunity to study your psychological patterns. Every moment of panic is a chance to practice creating space between feeling and action. Every impulse to revenge trade is an invitation to examine the deeper beliefs that drive counterproductive behavior. The traders who eventually succeed are not the ones who never make emotional mistakes. They're the ones who learn from those mistakes faster than they repeat them. They develop what psychologists call metacognition, the ability to think about thinking, to observe their own mental processes without being completely absorbed by them. This observer awareness is what allows you to notice the impulse to overtrade before you actually overtrade, to recognize the urge to abandon your strategy before you actually abandon it, to feel the pull of FOMO without being dragged into a bad trade by it. Most traders operate on autopilot. They react to market movements without conscious awareness of their internal state. They make decisions based on whatever emotion is strongest in the moment. They're like passengers in their own minds, along for the ride but not really driving. Developing metacognition means becoming the driver again. It means creating enough space between yourself and your thoughts to choose which ones to act on. It means recognizing that you're not your emotions. You're the consciousness that experiences emotions. This isn't mystical or abstract. It's practical psychology that can be developed through simple daily practices. Meditation teaches you to observe thoughts without being swept away by them. Journaling helps you identify patterns in your thinking and behavior. Mindfulness practices create space between stimulus and response. But perhaps most importantly, viewing each trading session as a laboratory for psychological development changes everything. Instead of just trying to make money, you're also trying to understand yourself better. Instead of just analyzing charts, you're also analyzing your own mind. This dual focus, external market analysis and internal psychological awareness, is what separates professional traders from gamblers. Professionals know that the market will always test their psychology. They prepare for this test by developing emotional resilience, self-awareness, and the ability to make decisions from a centered state rather than a reactive one. The market becomes not just a place to make money, but a mirror that reflects your psychological development. Every trade becomes feedback not just about market timing, but about your level of emotional mastery. Every loss becomes tuition paid toward greater self-understanding. This perspective transforms the entire trading experience. Instead of feeling like a victim of market randomness, you begin to see yourself as an active participant in your own psychological evolution. Instead of fearing losses, you begin to see them as inevitable steps in the learning process. Buffett understood this intuitively. His greatest investments weren't just financial successes. They were demonstrations of psychological mastery. His ability to buy Coca-Cola during market turbulence wasn't just good timing. It was evidence of his capacity to remain calm and rational when others were panicking. His willingness to admit mistakes publicly wasn't just transparency. It was proof that his ego no longer needed to be right more than it needed to be profitable. His patience to hold investments for decades wasn't just strategy. It was the natural result of emotional equilibrium that allowed him to think in long-term cycles rather than short-term fluctuations. This is the lesson that most traders learn only after losing money. That success in markets isn't about conquering your emotions. It's about developing a mature relationship with them. It's about creating enough internal stability to make decisions based on analysis rather than impulse, on strategy rather than reaction, on wisdom rather than fear. But wisdom doesn't come from reading books or watching videos. It comes from making mistakes and learning from them, from experiencing the discomfort of poor decisions and using that insight as motivation to develop better habits, from recognizing that every loss is tuition paid toward eventual mastery. The question isn't whether you'll face psychological challenges in trading. You will. Every trader does. The question is whether you'll use those challenges as opportunities for growth or as evidence that success is impossible. The market will test every aspect of your psychology: your patience during drawdowns, your discipline during winning streaks, your ability to think independently when everyone around you is following the crowd, your capacity to remain humble when things are going well and resilient when they're going poorly. These tests never end. Even Buffett, after decades of success, continues to face psychological challenges. The difference is that he's developed the mental framework to navigate them without being overwhelmed by them. He's learned to see challenges as part of the game rather than as personal attacks on his competence. This mature perspective is what allows him to admit mistakes publicly, to change his mind when new information emerges, and to remain curious rather than defensive when his analysis proves incorrect. It's what enables him to buy when others are selling, and to remain patient when others are desperate for action. Most importantly, it's what allows him to see trading and investing not as battles to be won, but as skills to be developed, not as tests of intelligence, but as exercises in emotional maturity, not as ways to prove his worth, but as expressions of his commitment to continuous learning and growth. This understanding changes everything about your relationship with money itself. Most traders never realize they're not just trading currencies or stocks. They're trading their deepest beliefs about worthiness, security, and survival. Every position you take is a projection of your unconscious relationship with abundance and scarcity. When you enter a trade, you're not just risking capital, you're risking your identity, your sense of competence, your belief that you deserve financial success. And the market, with its efficiency, will expose every crack in that foundation. Think about the last time you held a losing position too long. What was really happening? On the surface, you might say you were waiting for the market to turn, but dig deeper. Weren't you really avoiding the psychological discomfort of admitting you were wrong? Wasn't closing that trade tantamount to confirming some deeper fear about your capabilities? This is where most traders get trapped. They think they're managing risk, but they're actually managing their self-image. They think they're analyzing charts, but they're really negotiating with their own sense of worth. And this internal negotiation is what destroys accounts. Buffett learned to separate these two conversations: the market conversation and the identity conversation. When he bought a stock, he wasn't proving anything about himself. He was simply allocating capital based on probability and value. When a position moved against him, it wasn't a reflection of his intelligence or worth. It was just information about market sentiment and timing. This separation is profound. It's the difference between trading from ego and trading from awareness. When your identity isn't on the line with every trade, you can make decisions based purely on probability and risk management. You can cut losses without feeling like you're cutting pieces of yourself. You can take profits without needing the market to validate your brilliance. But achieving this separation requires confronting the deepest patterns in your psyche: the voice that says you're not smart enough, the fear that you'll always be broke, the pressure to prove that you're different from everyone else who has struggled in this game. These voices didn't start with trading. They've been with you since childhood, shaped by every interaction with money, authority, and success you've ever had. Trading simply amplifies them until they become impossible to ignore. Consider this. Two traders execute identical strategies with identical capital. One consistently profits, the other consistently loses. What's the difference? It's not intelligence, it's not market knowledge, it's not even luck. It's the internal dialogue that runs during moments of uncertainty. The profitable trader's mind says, "This is just another trade. If it works, great. If it doesn't, I'll cut my loss and move on." The losing trader's mind says, "I need this trade to work. If it doesn't, it proves I'm a failure. I can't afford another loss." Same market, same strategy, completely different internal experience. And that internal experience determines everything. The losing trader will hold positions too long because closing them feels like a painful admission. They'll overtrade because they're desperate to prove their competence. They'll abandon profitable strategies after short-term losses because their inner critic convinces them that nothing they do will ever work. Meanwhile, the profitable trader treats each trade as data collection. Win or lose, they're gathering information about market behavior and their own psychological patterns. They're playing a long-term game where individual outcomes matter far less than overall process improvement. This shift from outcome focus to process focus is revolutionary, but it requires a level of self-awareness that most people never develop. It requires looking honestly at your motivations, your fears, your unconscious beliefs about money and success. Most traders avoid this introspection because it's uncomfortable. It's easier to blame the market, the broker, the news, anything external rather than examining the internal patterns that create consistent failure. But the market is just a mirror. It reflects back your psychological state with ruthless accuracy. When you're desperate, you'll see setups that aren't there. When you're overconfident, you'll ignore obvious risks. When you're afraid, you'll hesitate on perfect entries. When you're greedy, you'll hold winners too long and turn them into losers. Your emotional state literally shapes what you perceive and how you respond. This is why meditation and mindfulness practices have become so popular among successful traders. Not because they're trendy, but because they develop the capacity to observe your own mind in action, to notice the emotional currents that influence your decisions before those currents sweep you away. Buffett discovered this through decades of expensive mistakes. Each loss taught him something about his own psychology. Each error revealed another way his emotions could sabotage his judgment. And slowly, patiently, he built a mental framework that could withstand the psychological pressure of volatile markets. But the framework wasn't built overnight. It was forged through years of practice, of making mistakes and learning from them, of developing the humility to admit when he was wrong and the wisdom to change course when necessary. The key insight is that emotional mastery isn't about eliminating emotions. That's impossible and counterproductive. Emotions provide valuable information about market conditions and your own psychological state. The goal is to feel emotions fully without being controlled by them, to use them as data rather than letting them drive your decisions. This requires developing what psychologists call emotional intelligence, the ability to recognize emotions as they arise, understand what triggers them, and choose how to respond rather than simply reacting automatically. You wanted control over the markets. Now you understand that control was never the goal. Understanding was. The moment you stop fighting your emotions and start working with them, everything changes. Your worst trading day taught you more than your best one ever could. Each loss was tuition paid toward the only education that matters, the education of your own mind. Buffett's $200 billion mistake wasn't really a mistake at all. It was the price he paid to discover that success isn't about being right. It's about staying steady while being wrong. If this shifted something inside you, if you see yourself differently now, then the real work begins. Subscribe and join others who understand that mastering the market starts with mastering the mind, one trade at a time, one breath at a time.